Welcome on board Gaurav Kochar, Fund Manager, Equity and Mirae Asset Investment Managers, joining in on the show right now. Gaurav, hi, great to have you on the show today. Dissect for us, what is it that you've made of, the three things that really stand out from amidst the Q2 updates of banks so far?
Yeah, very good morning, and thanks for having me here. So, some of the banks have reported their pre-quarterly release for the second quarter of FY25. So, based on this, I think the trends have been mixed. If I were to give three key takeaways from that, one would definitely be that the loan growth has been quite mixed. Banks with higher credit deposit ratio, they've seen some moderation in growth, loan growth, and they've seen some acceleration in deposit growth. Whereas banks that were sitting on comfortable CD ratios are seeing better credit growth than deposit growth. So this has been a trend for the last couple of quarters, and it's continued even in the second quarter. The second aspect was, the PSB, the public sector banks, continuing to see a very good credit growth even in this quarter. So most of the PSBs that have reported numbers have seen double-digit credit growth, which is quite good. And the third key takeaway has been on asset quality. Some of the unsecured banks with higher share of unsecured have seen both moderation in credit growth as well as some challenges in collection, be it in the MFI space, cards, or personal loans. So that seems to be the broader trend, from the press releases that have come so far.
Okay, so those are the broad trends that you're identifying, Gaurav. But if you had to break it down, let's say PSU banks versus private banks, where do you see more value and risk reward being skewed on the positive side right now?
Sure. So I think taking a slightly longer term view, visibility of, let's say, mid-teens kind of growth in the private sector space, I still feel private banks are better placed. If I look at the valuation and the ROE metrics that we keep tracking, they are quite healthy for private sector banks. So in that context, if I were to take a 2 to 3 year view, I think private banks are very better placed. Even within PSBs, a large part of the earnings growth is behind us, and from here on, the earnings growth would broadly mirror the balance sheet growth because of very limited ROE expansion from here on. So to that extent, I think the PSBs, from here on, could maybe taking a 6-month view, maybe outperform based on excess liquidity that is lying with them. The growth trends could remain healthy for the next 2 to 3 quarters. But taking a slightly longer term view, I think private banks are better placed.
Curious to get in your take as well as to what the outlook is when it comes to the NBFCs, given the fact that the rural recovery seems to be the key trigger point and there have been a lot of government initiatives here as well. What's your outlook on how one should look at NBFCs?
Sure. So NBFCs for the quarter have seen decent growth. The growth has moderated, but it's moderating on a very high base. So that was on expected lines. In the last 2 years have been phenomenal. And from there on, even if NBFCs are growing 4 to 5% on a sequential basis or mid to high 20s on a YOY basis, that's a decent sort of an outcome. Coming to your question on rural, yes, I think we all await more data points to get comfort on the rural recovery. I think the monsoon has been good, and probably we are in the festive season. So maybe next couple of months we'll know if the demand picks up and the credit outlook overall for the NBFCs improve from here on. And we are quite hopeful and optimistic for the second half. We've heard some of the managements speak about some recovery that they expect in the second half of this year. So yeah, we remain bullish on the rural recovery happening. But yeah, we await some data points to get more sort of constructive.
Yeah, but break it down within NBFCs, microfinanciers, you have, of course, gold financiers, you have housing finance companies. What's your pecking order between all of this?
Sure. So housing remains the key sort of longer term theme. I think it's a structural theme. So we like housing. Gold prices have remained firm because of the geopolitical uncertainties around us. So I think gold prices remaining firm bodes well for the gold financiers. That has done well. There's been some market share gain story for existing incumbents, which is also playing out quite well. On the MFI side, there has been some pain. Last 2 quarters, we've heard a lot of companies talk about consumer leveraging has gone up. There's been over leveraging in the sector, and also at the same time there have been tightening norms both by the RBI and the SHOs or the SROs. So clearly that will play out in this quarter and perhaps one or two more quarters, where you will see collection efficiency dipping and overall asset quality stress rising for the MFI space. That's true not just for MFIs, but even for some of the unsecured finance, be it cards. We've seen that in certain pockets of personal loans, low ticket or small ticket personal loan as well. So I think all of that linked to the small ticket financing, I think that seems to be moderating a bit. So the pecking order remains housing, followed by gold, followed by the unsecured, which includes MFI.
Quite interesting. And could you spell it out in terms of what the hierarchy or the the order of preference is within the entire financials cluster?
Sure. The order of preference remains large private banks, followed by the PSB. So banks over NBFCs from a medium term. We like certain NBFCs, well-capitalized NBFCs with strong parentage as a structural theme for the next 2-3 years, given that, we expect the demand trends to improve from here on. And next couple of years, we're talking about a rate cut, perhaps, towards the end of this year and FY26. So that typically benefits the NBFCs with large fixed rate book on the asset side and floating rate book on the liability side. So we are bullish on select NBFCs as well. But as a pack, we prefer banks over NBFCs from a medium-term standpoint.
And where is it that you're seeing areas of stress down the line? And how are you looking at the overall credit costs, which have of late, Gaurav, been normalizing?
Yeah, I think use the right word, normalizing. We've been through a very benign credit cycle over the last couple of years. So any jump in the credit cost, looks as a surprise. But if you look at a slightly longer term time frame, last 5 years, we are trending still lower than the 5-year average. So in that context, I think some normalization was given in FY25, FY26. And the pockets of stress, as I highlighted, continues to be the MFI segment, unsecured space, credit cards. Nothing unusual on the corporate side as yet, barring maybe a couple of accounts that could slip, which is a very normal sort of an outcome. But a broad-based sort of trend indicates that the corporate asset quality is healthy. That's roughly 35 to 40% of balance sheet of banks. So if that bodes well, I think overall asset quality outcome remains benign. There's not much stress in other than unsecured retail so far. And there are no data points to suggest that, this could spill over to secured asset classes or any other sort of, line of credit, be it housing, auto, etc. So we remain constructive on asset quality, barring maybe a few pockets of unsecured.
Okay, Gaurav, going to let you go on that note. Appreciate you taking the time out. So that's the view coming in from Mirae Asset Managers, talking about the preference towards PSBs. As of now, rural recovery awaits a little more clarity for the NBFCs, but collection efficiency is likely dipping in the next 2 to 3 quarters.
There comes a time when your heart calls for you to arise. Plant your feet solid into the ground. Decide your own limits, and then break right through them. Become something more. It's my time to rise.